Good day, traders. Stacey Burke from Stacey Burke Trading. Again, thank you for all the questions, emails, feedback, comments. I've had a bit of a break, school holidays and storms, and 3 states now in lockdown from the COVID crisis in Australia. So again, thank you. Just take a moment for me and hit the like button, subscribe if you haven't already, turn on your notifications. That will alert you when new content comes out. Today we're going to be talking about mastering the market maker and mastering yourself. So let's get into it. So we're going to review some of the basic concepts, and we're going to talk about multiple instruments today as this applies on any instrument that I trade. This is the process that I use on any instrument that I trade, and there's a very specific reason for me doing that. Regardless of what I do, it's important that you understand what your instrument actually offers you in terms of opportunities, and when those opportunities present, how they present, and what your expectations can be from those trade setups. But today we'll specifically look at some different instruments. We'll look at the S&P, we'll look at oil, we'll look at gold, we'll look at some of the currency pairs. Most importantly, I need to emphasize some things that some questions keep popping up. I had one person email me and say, obviously you don't have anything else new to talk about, so maybe you should do this and maybe you should do that. I need to emphasize that my trade setups don't change. It's the same process day in and day out, week in and week out, and there's a very specific reason for that. That's because I'm trading or trying to trade my scalable setups with the market maker. Now that has come from considerable learning and a lot of painful learning through many, many hard-earned lessons, through tears, through struggle, through frustration, through financial losses. And there's a very specific reason why I trade the way that I trade. Now, we're going to talk about some simple concepts that we've talked about in the past with the 12 candle window, but I'm going to try and clarify some things in a bit more detail. And then we'll take a look at the charts. So the biggest thing to understand is once you identify the setups is to understand that for myself, those are the only setups that I trade. And so there are days that I label low probability or high probability based on how that daily setup evolves, based on the weekly setup, all of those things, because understanding what the market maker is doing gives you an insight or offers you insight into the potential that is there for that day. And so instead of trying to go to the market each day and trade swings and moves and get in at levels and all this to get pips, that's when you're trying to trade every day. I've made mistakes where I've been in a trade for less than a minute and made an entire week's income in a matter of 10 seconds, just from being at size in a wrong direction. But that also shows you that when you start to do things right, you don't need to sit at the screen all day. You don't need to be clustering your charts up with all kinds of indicators and reading reports and looking at things that really have nothing to do with what the market maker is going to do. Everything that you see on the chart is them designing and architecting a chart for that day in order to serve their means. So they obviously need to either accumulate or distribute positions in order to make money. So they want to trap retail volume or other institutional, smaller traders, smaller institutions on the wrong sides or the other sides of their trades. And so the name of the game obviously is to transfer money from the many to the few. And it's a zero-sum game. So in order for them to profit or to execute their order flow, they need other traders to take positions on the other side of the market. And that's what we're going to talk a bit about today with this mastering the market maker, mastering yourself. So just on that second part, understanding that once you have taken your trade, once you've executed your trade, and you've gotten your 20 pips, your 40 pips, your 100 pips, whatever that may be, walk away. Learn how to scale those up in size, not coming back each session or each day going like I'm going to try and get 50 pips today. You can get 50 pips a week, and if it's scaled up over time, that can be all you need to trade. 25 pips is large enough if you're trading enough size. So, and again, to clarify on that, as somebody brought up previously in a video about blowing up your trading account from trading too big. At no point have I said to just trade big. Learn and master the skill of executing your best trade setups that are scalable and grow them in size and stick to those. The ones that, for me, the stop hunts, the vertical moves are the trades I like to be in because they're over fast, they explode, and there's a reason and a psychology behind why they do that, but they're scalable. And I'm in and out. I have very little heat. They happen at specific times on certain types of setups over and over again. And they're going to continue to do that because that is how the market works in order for the money to go from one account to another. So again, just to review, the focus for me is the high and the low of the day. Now, each day when we go into a new session, the previous session's high and low are what's important. So again, over the session itself, the high of that session may move down lower. As the market swings lower and lower, they may move the high of that session lower, and as we head into the next session, that is the most relevant recent high. So people call those swing highs, swing lows. No, that's the session high. As the market moves in one direction and makes new lows or new highs, that is now moving down in either a trend or to trap volume down low. And that becomes now a lower rectangle or an upper rectangle. So we talk about the round numbers. Most of these trades will execute off the major round numbers, 50s and double zeros, and the quarter levels will serve as areas where volume will get trapped up high or down low before the market continues or reverses its move. So again, asking yourself, who's in the money? Where are the stops? Which trades are in profit? And having an expectation if that stop loss level is 100 pips away, well, the market may not move there in one move. It may move there over the course of 3 sessions, 2 days, whatever. So understanding what a reasonable expectation is for the instrument that you're trading. So for example, the Aussie dollar may only move 20 pips in one session at best. But over the course of a 2 or 3 day setup or a 2 or 3 session setup, it may have a 30 to 50 pip stop hunt that moves strongly in one direction. Whereas opposed to gold, where we may get a 50 pip move every session and maybe 150 in the US session, or London if it's at the high or low of the weekend. The same applies for Asia. So understanding what the instrument you're trading offers in terms of its average daily range, an average session range in terms of high and low of where you're at. What is the asymmetrical risk reward of targeting one side to the other? If it's only 20 pips, you may only get 20. So timing window, again to review: Asia 8 to 11 p.m., London 2 to 5 a.m., and New York 8 to 11 a.m., and that is New York Eastern Standard Time. So I get this question all the time: what time is that in London? What about London being the start of the day? This is how the market works. It starts on a 24-hour cycle beginning in Asia based on New York Eastern Standard Time. You can trade the other times. We'll talk about the gap times in a second. But for me, that middle hour is the most important. Now, there are often continuation moves in that first hour, or moves that begin in that first hour, but often the acceleration will happen in that second hour. If it's New York, we may be up high or down low, so that equity hour may actually now trap people. Same with London. If it's high or low of the week, they may be trapping people up high or down low and moving it in that third hour in the other direction, meaning that the equity market opens up. Now we're up, the market's already moved in that first hour. That second hour then becomes the extended move of trapping traders up high or down low before it reverses in that third hour or at the end of that third hour. So if the market's already moving, you have to be thinking now that we're being taken further away and there's going to be a setup or an aggressive move, whether it's at the end of that session or into the next session. Gap times are typically high of day, low of day, or week trade setups only after stops have been hit. So once they've cleared out a level in that gap time, you will often get a reversal trade, especially in gold, headed into the New York session. Or those moves will be capitulation moves in the gap time if you're already in an existing trade before the reversal sets up for the next session. Engulfments, pin hammers, and then, of course, how you're going to manage your trade, meaning that when, as I've talked about, when I put my trade into the market, it has a preset profit target. I may have multiple positions where I have multiple profit target levels to make sure that it's taking me out as it's moving, and then leave one to trail. It, again, depends on the setup and which session we are in, but typically I will just set a profit target. And depending, again, if we're trading into major round numbers, I'll adjust it with the spread to make sure that it takes me out, because it may pin to a number without going through a number, meaning that it might go to 50. So I want to get taken out of 55, that sort of thing, and adjusting your profit target based on knowing that the market may hit stops, clear out a level, but only extend to the numbers and not go through the numbers. And here's a really important thing. I use 15-minute charts to identify the levels, not to trade. So, for example, if my 15-minute high-low is at 50 and 125, I'm looking based on the time frame. If we trade into the high or the low on my 1-minute charts, I'm in that timing window. I'm using my 1-minute charts for those trade setups when it goes to the high or low of the day. Those 15-minute charts give me my levels. So people talk about, what about the 4-hour trend, the 1-hour trend? It's about the price level, how price behaves. It may be a trend trade, but we'll still have some kind of pullback and continuation. But specifically, again, coming back to that 3-hour window and most importantly, the equity hour in the middle, that is what will give me my trade entry based on how price behaves. So it's the level, not the candle formation on the 15-minute chart. So again, if the trade's at 50, it's at 50. If you get in on the 15-minute chart, you might get filled at 65. Whereas if I get in on the 1-minute chart, I might be getting in at 51, 48, whatever that may be, depending on how that setup has happened. So it's important to understand where are your highs and lows. How does price need to behave in that timing window for me to enter that trade? So there might be a daily template setup, so it just may be a session high, session low, Asia-London setup. It could be a weekly template setup, like a Monday, Tuesday, Wednesday, a 3-day setup. We'll look at a couple examples of that. It may be, again, a 3-day setup into the news. So we could get a day 1, day 2, day 3, trapping volume up high with 3 pushes, and then a vertical move on a news catalyst. 3-session setup, same thing. Asia, London, New York, moving lower into the New York Open. They can go vertical through the high of the day. Payrolls, it doesn't have to be news. It can just be a squeeze. We could have a first red day or a first green day, which often happens on a Friday, Monday type of scenario as the week may change directions. And we'll look at a couple of great examples on some of the pairs from this week. And then again, it could be a trend day, which we've talked about, the day 0, peak formation high, peak formation low. Saw an example of this on gold last week, and we'll look at some examples of how this can be important to understand when you're in an all-in day, because you do not want to counter trend on those days. You will get smashed. So again, understanding the setup that you're trading. What is the psychology behind the trade? Do they have trap volume and it should be a fast capitulation move? And that comes from your understanding of not only the instrument that you're trading, so again, knowing the instrument that you're trading and the behavior of that instrument, and then also knowing what creeping trends are. Creeping trends resolve themselves in one of two ways. They will reverse and go vertically hard and fast the other direction, which is typically a squeeze, or they will capitulate and complete a move in a blow-off fashion in a fast vertical move, which we again see on any pair when that setup is right. Typically we can see that at the low of the week, the high of the week type of scenario. So order flow in any time frame, a creeping trend is building order flow, and we'll look at some examples of that, especially heading into the opens of sessions. Very important to understand. So let's take a look at some charts. So if we take a look at the S&P 500, this is a great market. I want to make one thing clear. When I look at the S&P, I only look at the U.S. session. I do not look at the other time frames, specifically because the S&P 500 trades biggest volume when the New York market opens. And so I know it will look like there are other trades on this chart. But it's also important to understand that when you trade outside of the U.S. session, the volumes are likely going to be a lot thinner. But again, my approach to the S&P is specifically the U.S. session. And so talking about that, again, coming back to 15-minute charts, identifying the high and low in that first hour as my window into assessing the trade opportunity, whether I'm looking for a short trade, a long trade, or no trade. And so over the course of the week, we see the same behaviors: Asia, London, New York, the weekly template, Monday, Tuesday, Wednesday. And again, in the U.S. session, we can see some very explosive moves to either continue a trend in that middle equity hour. So again, understanding on our 15-minute charts, we have our major round numbers. We have our first hour high and low. The first hour will often establish the high and low heading into that session. Now, if stops have been hit, or we already have a bias based on the previous two sessions trading into that session, well, that gives me an even easier opportunity to have a bias about the direction I want to be trading. Now, also, again, I'm looking only for certain setups. So I could look at the chart on a certain day. We can see that Asia, London, New York opens down low, but we may be in a low probability setup because we've got a lot of chop, or I'm looking at a lower probability type setup in terms of risk reward, or maybe one that's going to be more volatile, and I just won't bother. So when I see a lot of wicks or a lot of sideways action, I'm looking for something specific in terms of, again, where is the market going? Why is it going to want to move in that direction? And again, coming back to the thesis of zero-sum games. Somebody needs to lose. Where are they going? What is it? Who stands to be the most disappointed? But again, we look at our 12-candle window. The pink line is our Monday. Monday, Tuesday, typically 80% of the time we'll establish our upper and lower boundaries for the week. One of those typically may hold as the extreme. So again, if we're in an up week and the market's gone down, giving us a peak formation. So again, people ask, what is a peak formation? When the market goes down vertically and pulls back and moves away, now this becomes a peak formation low. Now, we talked about creeping trends. Anytime the market is moving in waves, this is order flow, generating order flow. The market goes vertical, 1, 2, 3. That's a stop hunt. The market resumes its creep into the low for an explosive move all the way back up, taking out all of these short trades that were building up into the low. So any time frame, whenever you see this creeping movement, you have to be thinking and looking for the opportunity that will present for the reversal and the explosive fast move. 4 hours creeping down, 1 hour vertical, taking out the entire 4 hours of creep. 4 bars, 1 hour, 4 hours of creeping trends. Bear candles, bull candle. Bear candle, bull candle. Creeping trends will resolve themselves in one of two ways. Creeping trend up, creeping trend down. This creeps back into that demand area at double zeros. So again, we talked about session high, session low. The market creeps down, hits stops on traders that are long. It doesn't need to take out the low. Creeping trend down, reversal, sideways, bullpen hammer on the 15-minute chart. The level is double zeros after stops have been hit in our 12-candle window. Again, this is London, but then we get the creeping trend up for the vertical explosive move through the low on traders that are long. So again, for me, I look at the U.S. session only for the S&P 500. But again, the session high, session low, first hour giving me my, if you're not in that capitulation blow off into the session, then we're thinking that we're up high. That equity hour may be trapping traders up high for the fast explosive move back down. So with each instrument you're trading, whether it's a currency, a commodity, whatever that is, study that and know when it's going to move, when the volumes are going to swell, how the market may be accumulating positions over the course of the day. Again, session creeping trends, Asia, London, if it's going to move bigger in the U.S. session. So again, if we just come to this week, this is a great example. Yesterday, the market makes a high in Asia, makes a high or a low. This goes for any instrument typically. So a lot of the currency pairs don't move that much in Asia on average, but the market will establish a high. So we have our previous U.S. session high, and then we have our previous U.S. session low, which of course was down low. The market made lower highs. The market exploded up and took out those lower highs, took out the session high. Then it proceeded to go down and make a low of the day. So again, coming back to what I said, the market came up in London session, made a higher high. I only look at the New York session. And then we get the gift. The gift is the creeping trend. 1 push, 2 pushes, 3 pushes, and then into the U.S. session, a vertical move down to the low just prior to the equity hour opening, and a reversal off of 50 after stops have been hit for an explosive reversal bullpen on the 15-minute chart, but down on the 1-minute chart there would have been a reversal entry somewhere between 50 and 75, if not at 50, as the market pinned down through the stops down to the quarter level. So again, all this volume over the course of the day becomes a daily setup of trapped volume. Trapping volume down low, chasing the shorts. Traders, if they didn't take money off, this is over a 100 pip move on S&P into the open of the equity hour. So again, clarifying that there's a move down, but then the explosive move for 400 or 500 pips up comes on the vertical move after stops have been hit in that equity hour. So again, just kind of understanding that when you get a really good setup, or the possibility of a good setup evolving that is scalable, and again, you'll notice that on most days the S&P has great movement in that U.S. session. When you get an opportunity like this, okay, this is why you can step back and realize that all this other stuff, okay, this is the market maker building volume up over the course of the day and then having the explosive move later. The explosive move is where the big money can be made. Scalping pips every day is one approach. My approach is to step back and wait for the better opportunities off the high or low of the day or the session. So we've recently saw some explosive moves on West Texas crude oil, back down after having an exceptionally good run off of the historical lows, but again painting the understanding that every instrument works very similar in terms of the timing windows. And again, for something like West Texas oil, I would only focus on the U.S. session. Now obviously we can recognize that there's movement in these other sessions, but then you need to understand with your broker, the instrument that you're trading, how the spreads fluctuate. Something I didn't mention with the S&P is that the spreads are wider until we get to that U.S. session window. The volume is thinner. So if you actually plan on scaling any of those trades up outside of the U.S. window, you may have slippage. There may not be as good of execution in that other time frame. So again, West Texas, I would trade only in that U.S. session, specifically looking for that equity market opening. But again, in that first hour, once the volume is there, I would be willing to participate in a move if it was in a capitulation or an accelerated position. And again, something we're not going to go into, but we talked about was the gap time. So the gap times can sometimes already be in an accelerated trade mode. But again, knowing that your spreads may change during these times prior to the U.S. window and the volume. Obviously, for some of the currencies and gold, that may not apply. But definitely, even if you're not in a move like this, you'll see the market again pulls back and stop hunts into traders who are in that gap time short before continuing the move in that U.S. equity window. So again, it's about the level, not the time frame. So once we have the level, the market's broken double zeros, we're in an accelerated down move, the level is zero. I'm looking for something where I get the trade entry in this window once the equity market opens on my 1-minute chart. My levels have already been established. I know there are stops down below 75. I know the market's in an accelerated move in the downtrend. And then again, similar to the S&P, we see a setup evolve over the course of the day. The previous day's low, the New York low, this is the low of the previous New York session. The market pulls up, clears out the lower level shorts in Asia and establishes a high of the day before coming back in our Europe-London window to take out the high of the day before trading sideways in a creeping consolidation. Again, creeping trends, trap volume, and then pulling back and hitting stops on the low of the day without taking out the low of the previous New York session. So we have a consolidation locking in the high. They extend the current low of the day and go into our creeping trend. Creeping trends resolve themselves in one of two ways. We get a stop hunt to the high of the creep in the consolidation, and then a vertical acceleration move into the low, hitting stops, and then an explosive reversal in the equity hour. So again, the timing window, you don't need to be at the screen all the time. If you study creeping trends, if you understand that the high of the day and the low of the day are session highs and lows. So as New York traded, they made a lower high. This now becomes the high of the day, the new high. They're going lower, they make a low of the day, they lock it in. This is the New York session high. Unless they take this out, this remains the high of the day. Where's our major round numbers? Okay, well, chances are I'm going to be looking for something around $67. They go through there in London. Okay, well, as we head into the New York session, we're not at the high or the low. They go down to the low. If you're in this move down to the low, know that you can see that trade fail at the low. So you want to be taking profits. But again, not necessarily getting out at the low. You may accelerate this on a smaller time frame down as far as that takes you before taking you out of the trade, but understanding now that you may see an aggressive, explosive move for a trade setup off that low level at 50, back through the high of the U.S. session high, which is now the new high of the day. This trade actually completes back through the current high of the day. So again, just coming and looking at crude, we can see the markets traded down, peak formation low, possibly setting up for a day zero reversal trade coming back up in that long direction. Now again, if it was to roll over and take out the low, that negates that, but we now have our peak formation low and a higher high, and the market's in consolidation. Inside of that peak formation low, we could see a stop hunt low and then a move back up in that long direction, possibly in the U.S. session. So a lower high in London heading into New York, pulling back, stop hunting into traders that are in early before continuing that move and going after first place U.S. session highs from yesterday's session. Now, as many of you know, gold is primarily the only instrument. Again, I'm looking at oil and S&P in the U.S. session for trades. Out of these three pairs, which one offers me the easiest to identify for possibly an explosive, zero-stress trade setup in that open? I'm not hanging around trading in here waiting for this market to do something. When I see the creeping trend, I lick my lips because I know I'm going to get a vertical move. Either a stop hunt down and a reversal, or a stop hunt up and a stop hunt down for an explosive move up. Whenever the market gets dragged down low and they go into a creep, you have to know that there is going to be a couple of trade setups. One for this vertical move. We're at the low of the week. It's a Monday peak formation low. They pull it back inside. They consolidate on top of that lower trap volume. Heading into the next day, they pop it above double zeros. This 2-hour move down is a creeping trend on a smaller time frame. So the 1-minute chart, and we'll look at that. This was yesterday's session. The 1-minute chart gave a beautiful creeping trend into the open of the session. So again, they made a high, and understanding if we draw our M, we can see the M at the rollover. We have one level of drop. They make this again. This is all before the session starts, and then they go into the second level. So one level, two levels. We've talked about 3 levels of rise or fall, and then of course we get 3 pushes into the end of that second hour prior to our Asian 12 candle window. So this is a great example of where a trade moves prior to the market in that early hour, the first hour. But again, that equity hour is the most important. And so take a peek at the creeping trend that evolves headed into the open. We get 1 push, 2 pushes, and then a 1, 2, 3. Last candle of the hour is the bullpen hammer after 3 pushes and a creeping trend after a move up. Market goes into consolidation, 1 push, 2 push, 1, 2, 3. Bullpen hammer explodes through 50, continues for the second 25 for 50 pips. This is a perfect, scalable textbook trade setup. So again, understanding it's a Tuesday, the psychology behind this move is to take out the high of the week. So peak formation low on a Monday, peak formation high on a Tuesday. And again, the vertical move back inside of the U.S. session. The market moves up, creeps down into the low of Asia. So again, it doesn't take out the high of the day. Creeping trend. We'll move this up. Get this up here. If we can, we'll just put a new stop up there. So again, a creeping trend down into the low of Asia before exploding back through the high of the day. So creeping trend down, explodes up, takes out the high of the day, and then we get a creeper up that capitulates in the direction of the trend, giving us our extended M. But you'll notice, again, as we head into the equity hour, the high is up at 50. So we're looking for something between 25 and 50 once they've come down and gone back up in the equity hour. Now this becomes trapping volume up high, chasing the longs when the equity market opens. We've got traders in profit not only from the beginning of the session, but now from the beginning of London. That bullpen hammer, at the end of the 12 candle window, forms our London low of the day. New York goes up and makes a high. They come down to the low and clear out stops at the low of the day for a 150 pip move down. Now you're going to see New York do this over and over and over again on gold. And again, we have a Monday, Tuesday. So we talked about peak formation high, peak formation low. So there's our day zero setup. They made a low, they made a high, we've gone back inside. So we're now possibly going to revisit one of these extremes. Now the market has gone down early to clear out the previous session stops on traders that got long at the end of the U.S. session. They have not taken out the low of yesterday. We're inside, we're below double zeros, creeping trend. So we're either going to see this creep down into the low of Asia for an explosive move up possibly, or back up into the high, the open of Asia, roll over and work its way down, possibly pull back in the London session into New York for a vertical move through the low. But this peak, we had a first red day on Friday. We talked about this in one of the videos a few videos ago. We had 3 weeks basically of up, and then we can see the 3 pushes, and then our first red day was Friday. The market then continued, pulled back into the U.S. session lower high in Asia after our first red day to continue that move down into the open of the U.S. session, a vertical move for stop hunt back to the high of the Asian session. So again, these are explosive moves. The market moves down to 50. We're looking at for some sort of confirmation for that reversal on the 1 minute chart. This is a stop hunt. That vertical move is a stop hunt. So again, we're not getting in front of a falling knife. Price action will enter us in on this trade. You'll notice this market comes down for 30 minutes before reversing. This becomes a 1 hour bullpen hammer. Then the market pulls back into traders that are trading the 1 hour system. We got end of day traders triggered into the market. The market closes, and heading into the next day, we know end of day traders are short. They're short at the break of the previous day's low. This was a bullpen hammer on the daily chart. This triggers traders long on the bullpen hammer. And you'll notice that the market in the U.S. session is only trading back up into traders that are short from the previous New York session. So these are the sort of scenarios you want to be running through your head and understanding that there's a psychology about where the money is, who's in profit, and knowing when that creeping trend is evolving for an explosive move. So instead of trying to trade inside of this creep, knowing that when you see these creeping trends, that there's going to be an explosive move. And if you're in a vertical move coming out of the session, knowing that now you could be at the end of that move when we get the pushes heading into that equity and third hour setup. So the British pound, we saw a great example coming to the end of the week. We saw the consolidation and then the continuation down on Friday and a second day trade setup on Monday. So again, the creeping trends and then a consolidation. This is the dead giveaway when you get a nice tight consolidation in a trending market for a second day trade setup. Very tight, narrow range. The market then in our timing window continues to move down. So understanding that as we approach the timing window expiry, that 3 hour window, we want to be taking something off. You had 30 minutes without the market going into zeros. This is a great example of where in a trade itself, I would add the spread into this trade setup. So the market goes down and makes a low and pulls back on the bull candle. I know that that low now may be intact of that initial bear candle down. I want to be taking money off the table for this very reason. It comes back into your trade setup. So with the major pairs, you're not going to get the same volatility necessarily day in and day out that you're going to get with these other instruments, S&P, gold, even crude when the volatility is there. But understanding the simple concept that the market will make, we've broken through the previous session's low of day. So we broke through New York session. It continues into the next day. They make a low. The market puts a low in place at the end of the Asian window. It then puts a high in place. And the market is creeping down, pulling back, and then it engulfs and capitulates in the direction of the creeping trend. So people call this a trend trade. So that capitulation, the vertical move, 1 push, 2 push, 3 pushes, take the money off the table. You can hold on to it, and you might not get stopped out, or you might not have that trade. You'll notice that the stop hunt comes right back to where pretty much with the spread, they get most of the retail market on this time frame at break even. So understanding one more time again, it's about the price level. 50s to double zeros. The entry's 50 on a smaller time frame. even on the pullback, you want to get filled at best as possible to the numbers with the spread if you can. That way, if they do come back, if you factored in the spread and you're filled better than the numbers and you've held on to this trade and not taken money off the table, you're still going to be okay. The market obviously continued to move down, but traders that took money off the trade had the opportunity to get back in that next U.S. session window. Again, the market stop hunts back up to the quarter level. This all becomes trapped volume between 0 and 25 in a continuation market. When they break through the low, of the double zeros, the first thing you should be thinking is that they're going down because there are stops down here. This is first hour. The equity market has not opened yet. They're going to come back up into existing traders that are short. But the fact that they came down first, they set a low, and those stops are below double zeros, that there's a high probability now that if I'm on a smaller time frame when it's near the numbers after they've gone vertical, that I may see this market give me a setup between 0 and 25 on a smaller time frame for a move back down through the stops to continue the original direction of that trend. Same scenario. We have our low of the U.S. session. Asia goes up and puts a high in place. Okay, so everything inside of that high and low. So here's our original high from the lower U.S. session high. Okay, and then they gave us our low. Everything else inside, okay, is not a trade. This is trapped volume inside. So this is a box. If you're trading this stuff inside, okay, traders trade this short, boom, they get caught. The market puts a high in place, so there's our high. This is before we get to our Europe-London window. There's a high, there's a low. They come down in the Europe-London window in the first hour. They extend the low. They hit stops on traders that are long. They extend the low and lock it in. Now, we have a creeping trend. They give us a long entry inside of our 12 candle window back up through the lower high, hitting stops. Okay, so again, numbers, quarter level, 50s. They go down and extend the low. They've gone further down. They've put a new low in place. Then they've gone up, hit the stops, gone sideways, and reversed, coming back down through the previous day's low as well as the 50 level. So again, we know there are stops down here. Every fill on these candles going long takes you further away from the low. So every time you are forced to chase the price, you're getting filled further away from the low, which means when you see that, you have to be thinking they're getting me to chase a fill further away, rather than being a trade that trades into the low, as we see down low. So they trade down inside a small bullpen hammer at the low, doji, and then in the engulfment, you're trading off the low as opposed to putting a low in place and making you chase it further away from the low. So I hope that makes sense. So again, looking at today's chart, it's Wednesday, day 3. We've had a creeping trend up. They've extended that high. They've taken out the lower high from the U.S. session. And again, depending on how price behaves between now and the Europe-London Open, we may trade back up into the high to the quarter level for a move back down to the low. So we have our low of the week currently established down from last night's U.S. session, but we see that volume is chasing the price up high. They've hit the stops on that higher volume that was trapped in the upper quarter. Now we've made a new low. Depending on how price behaves into this short trade, we may see this market roll over and retest the lows that are going to be established from the low of the Asian session, heading back down towards traders that are long off the bottom. So day 1, day 2, day 3, we could see them head back down into this low, third day down for a possible reversal trade or a continuation of this move, or even just jamming traders in this lower 30 to 40 pip box down low for a reversal off of zeros into tomorrow's session. So hopefully you got value from today's video, traders. Whatever instrument that you're trading, understand to step back, look for these creeping trends, master the market maker, identify explosive scalable trade setups, wait for that opportunity to present. These trades are over in 1 hour. All the other stuff in between is going to become fuel at some point, and you don't want to be trading in this creep, because this creep isn't going to go anywhere. You're sitting there for hours hoping that it goes in the right direction. Traders short this, or they go long, it goes up 10, 15 pips and comes right back down. You want to be in the explosive moves when they've got volume trapped. Try to identify the quarter levels. So right now we're looking maybe at 0 to 25 as trap volume. We've already taken out the higher longs. They've come down through to make a new low of the day. We may see them trap traders chasing that long move before we get a vertical move down through the low. Now, obviously, if they take out the high of the day, they may be coiling volume down low for a move through yesterday's highs. But right now, with that move down this morning, I'd be leaning more towards a retest of that lower upper. The trap volume is above the double zeros. We may see a retest of the low of the week. So keep it simple, traders. Timing window, scalable trade setups, engulfments, pin hammers, level, price level, high and low of the sessions and the days. Look for trapping volume, creeping trends. Have a great trading session, and may the markets
Hi
go
traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.